All right, thank you all for coming today. We've got a few people in person and then a few on Zoom. So thank you so much for coming. So I wanted to start out with this topic and clarify that this is a really big topic. So we're not going to get into all the nitty-gritties of this topic. We are talking about multifamily lending, and I'm going to try to give you at least the key points for the different loan programs that offer multifamily lending and multi-unit lending, and that way you can have a really big overview. And then I will send some notes out as well to give you a little more details, and then you can always ask questions, because again, this is a big topic. We're not going to cover everything today. So first of all, we're going to talk about two categories of multi-unit. We have our 1 to 4 unit and then 5 to 24 unit lending options. Now, we live in a world where we mostly work with the 1 to 4 unit. However, the 5 to 24 unit is still a possibility. It gets us into commercial land, and it is a bigger down payment. It's not quite the same as our FHA, VA, Fannie and Freddie products, but it is an option, and it is something that if you have a client, especially with the realtors that are on here, if you have a client that is interested in that, it's something to explore, because it is an option. A lot of people think that they have to use potentially a local bank. That's their only option, but you can actually get that option in the broker world. So you have more options than you may think. But we are mostly going to cover 1 to 4 units. So first off, 1 to 4 units, the reason we like them and we like to talk about them, because they really can be a great avenue for people to start building financial freedom. What I mean by that is everything that I'm going to talk about today is mostly revolved around buying a primary residence with a lower down payment. Then you can utilize those other units within that, whether it's a 2, 3, or 4 unit, you can utilize that as income to help you with your mortgage and to offset some of the expenses. The great thing about that is it's a great starter option for people. They can buy their primary with a low down payment, and then they can, live in it for a year, 2 years, whatever they want to do, but then they can convert it to a complete rental property. So it's a really good way to build financial freedom, because then they can go on and buy another primary residence for a low down as well. So that's why we like to talk about it, because you can do low down with these multi-units. So I'm going to start with one of the most famous, I guess you can say, FHA multi-unit, because that's talked about quite a bit. So FHA, sometimes people get a little gun shy with any government loan, but FHA does have good multi-unit products. So you can buy a 2, 3, or 4 unit property. As long as you live in that one of those units, you can rent out the other units just as part of your income for offsetting that mortgage, like I said prior. And the tricky part with FHA and with any FHA loan is that you're also looking at the quality of the home. So again, sometimes people steer clear of FHA because they're nervous that the property won't qualify. But what we have found in the past is we've actually seen a lot of these properties come through, and there's a lot of things that as a lender you can talk to the agents about, and you can get the sellers on board and the buyers on board. There's certain small things that you can do in order to prepare that property for the appraisal to come through. And so I don't want you guys to think that FHA needs to be a perfect property. In our office, we have literally seen very unique properties come through just fine with FHA and VA. So when you're looking at, helping a first-time home buyer who has 3.5% down, looking at the FHA option is not a terrible thing, because it really can get a first-time home buyer into a really good financial situation. And there are a few interesting things with FHA, in particular when we're talking about multi-units. When you have a 2 unit, it's not a problem. But when you get to 3 to 4 units, FHA does have a very it's very specific to FHA. It's called the self-sufficiency test. Now, we are now at the beginning of 2024, and we are starting to see, just the overall mortgage market look a little better. Last year, 2023, it was harder to pass the self-sufficiency test for FHA. So the self-sufficiency test only applies to 3 to 4 units. When you have 3 to 4 units, what FHA wants is to make sure if that home is starting to go into foreclosure, that the rental of the 4 units will cover the mortgage completely, but also buffering in a 25% maintenance cost. So what that means is if the mortgage is $3,500, we need to make sure that the rent covers at least a little over that $3,500 because we have that maintenance cost as well. The problem is when the rates were a little higher last year, that was self-sufficiency was really hard to hit on some of these properties for FHA. The cool thing though is that if a home doesn't pass FHA self-sufficiency, and this is also something that we look at prior to even getting under contract, we can potentially just flip the loan to conventional and be able to use the conventional multi-unit option. And but that's kind of the tricky part with FHA. But again, we're starting to get into an environment that is a little better on this FHA self-sufficiency. So I think that more people should look at that option and not be nervous about it. Now, again, 3.5% down, FHA, multi-unit, it can be a great starter home for somebody. And then when you're talking to your borrowers, just keep in mind that they have to live in that property. So for some people, it's not going to work. They don't like that option. They don't like living next to their the other units. And so just have that conversation with your clients. Now, before I move into the next one, I do want to see, does anybody have any quick questions on FHA?
What's the max loan amount for the 4
Yeah,
unit?
so the really cool thing about FHA as well, so if you've been in the industry for at least a couple of years, you probably have run into max loan amounts. The cool thing is if you're in the Flathead Valley, the max loan amount is actually a little higher than other areas in Montana. But FHA has these parameters on 1 unit, 2, 3, and 4 units for the max loan amount. Now, the max loan amount is very important because when you're dealing with an FHA borrower who needs to utilize a low down payment, but also you're looking at homes that are pretty much at least $500,000 in a lot of areas, that max loan amount is important. But what's really great about FHA is when it goes to 2, 3, and 4 units, the max loan amount is actually really high. It's over $1 million for a 4 unit right now. So you can literally buy a 4 unit FHA home and it's $1 million. It's great. So 3.5% down can actually buy you that. So that's really cool about FHA. One of the cool things about FHA. Does anyone have a quick question on FHA? No. Okay, cool. All right, so we'll move into conventional. So conventional is another really cool product. So prior to 2023, and actually I think midway through 2023, the conventional option for multi-unit, actually you had to put like 20% down. So the great thing about that, actually you can do 15% down on a 2 unit and 20% down on a 3 or 4 unit. However, in 2023, there was some guideline changes. So Freddie Mac is still a little higher on the down payment requirement, but Fannie Mae has allowed for 5% down on a 2 unit and a 3 or 4 unit. And the other cool thing is you really only need a minimum credit score of 620. And that is actually one thing I didn't mention on FHA. You can actually go lower than 620 on FHA as well. So when we're looking at conventional, you can do a 3 to 4 unit with as little as 5% down. So with that, you do have a county loan limit. So it's a little different than FHA, and this is where you really need to look at kind of the big picture. it may make more sense to go FHA because you can buy $1 million property with 3.5% down. It's going to be harder on the conventional side because the conventional loan limit is 766. That's not $1 million, but you can do 5% down at that loan limit. So again, when you're looking at conventional multi-unit, it's something to keep in mind if it makes more sense for this client to go FHA because maybe the 4-unit home that you found is 900,000. It's going to be harder to go conventional. They'll likely have to put a lot more down to get within that county loan limit. So something to keep in mind. Now, again, this is for a primary purchase. So the people buying those units, they have to live in one unit. So they have to be okay with that. And again, financial freedom could potentially happen because they're utilizing these multi-units as a future full investment property. And also what I've seen in market trends right now, and we're seeing more builders actually trying to maximize space. So you might see some more duplexes coming out on the market. One question that you have to kind of keep an eye out, because I actually had a client in a couple weeks ago, and she was under the impression that she could buy one unit at today, for example, and then a year later buy the next unit. She can do that potentially, but she was thinking that that was a duplex, but it doesn't work that way. When you're looking at multi-units, it actually has to be on the same legal. So as agents, you should know what that means, but basically you can't, that's a townhome if you're looking at it that way, and that's different than the multi-units that we're talking about. So just know that you may get those questions. I literally had that question 2 weeks ago. So just make sure you educate your clients on the difference between a townhome and a duplex or multi-unit. Then the other thing is, we're looking also at VA. So VA is another option. When we're talking about low down, VA again has a great option for multi-unit, 0 down option for multi-unit. So the benefit for veterans is, it really helps them, and actually in all of these, it really helps them to, have their foot in the door, especially as we look at like our current market right now. Everything is expensive. So getting somebody in the door with 0 down on a VA loan can really help their future success again. I always refer to that because we talk about financial freedom in our office a lot, and helping somebody get their foot in the door and have half their mortgage paid or their full mortgage paid with rentals is very important. I'm going to take a quick sip. Talking too much, I guess, right? A few more people joined the Zoom. Welcome. All right, so with VA, the veteran has to qualify for a VA loan, which is super simple. Any lender can pull a certificate of eligibility. There is actually no loan limit. So we can actually do, into the millions for VA multi-unit. Now, the unique aspects of a VA multi-unit, in which is different than the other programs, is for VA, the veteran has to have a couple of things. One, they either have to have history of managing rental units. Now, if they don't have history of managing rental units, that is okay. We just have to actually have them, they have to hire a property management company. Now, if they hire the property management company later down the road, they can make adjustments, but for the loan program, they have to use a property management company. The VA really wants to make sure that the veteran's not getting harmed in any transaction. So they want to just make sure that, they're not getting into something that they can't handle. But that's the thing about that too, is that they literally have those options. They either have history of renting or they just hire a property management company. And then also with the VA, which is similar to FHA, people get a little nervous because the VA guidelines, FHA guidelines, again, having the conversation with the lender and looking at the property and really identifying what may get picked out on some of these can really help out with the appraisal process. Because one of the tips that I like to give agents is think about curb appeal. So if we can have the conversation about potential things that the VA appraiser might point out and have that ahead of time, I mean, it could be simply as just, painting that front deck and getting that first curb appeal. Because as soon as the appraiser starts walking up the door, if he starts seeing all chipping paint on the deck and that's the first thing he sees, he might think, wow, there's a few other things probably that might be wrong with this property. So one of the things that we go through is we really try to just look at the house as a whole and say, okay, what can we fix before the appraiser goes out there? Oh yeah, looks like I have a question. What if they have a family member who has
Property manager.
property management, okay, or a realtor manage it for them?
It's possible.
Yeah, possibly. The biggest thing with that is making sure that, like, for example, the realtor isn't the same realtor that is one of the agents on the transaction. It would have to be someone who's not a part of the transaction. That is kind of my first thought. But that should be fine because a lot of agents actually do that. Does that answer your question?
That's Kaylee. So.
Perfect. Okay. Yes. Awesome. So yeah, again, with the VA multi-unit, that it's a really cool product because you literally can get, you can avoid that conforming loan limit and get a veteran into a 3 to 4 unit property or a 2 to 4 unit property. The other cool thing about that is, let's say you find a 2 unit or a 4 unit, whatever the case, and it needs a little bit of work. So we can do an FHA and VA renovation loan on those multi-units. So the renovation loan product is great because if you do have one of those properties that literally it needs, potentially a new roof, or there's some cosmetic stuff going on, needs new flooring, needs new paint, we can throw them into a renovation product so they can still utilize the 3.5% or the 0 down product and get into a multi-unit. So that is another option too that we like to present to people. And then just going through, there's a lot with the ins and outs with multi-units. So when we talk about FHA, conventional, and VA, each one of them has a little different way to calculate how we utilize the rental income. That's why when clients come to our office, we try to literally give them a side-by-side. It's very rarely that a client only qualifies for one, but maybe they do. But if they don't, we do like to do a side-by-side comparison and talk about the pros and cons of each different program and see if it makes sense. Now, the one thing too that doesn't work, we get this question, and we're also in Montana, so I wanted to bring it up. Now, when we're talking about multi-unit, there's 2 things. A manufactured home is fine to use as a primary residence as a 1 unit. It gets really tricky and very hard to lend on a manufactured home if it's the second dwelling. So it can be the second dwelling as an accessory unit, but it can't be the second dwelling as a full second unit. So it's a tricky thing when we talk about manufactured homes, but we see it a lot in Montana. People put a manufactured home on a property and then later they build their house. That is basically a primary with an accessory dwelling on it. But when we start talking about manufactured homes, there's a lot of ins and outs with making sure it's detitled, it's on a foundation. And again, there's a few programs that we just have to get more into the details to figure out what makes the most sense for that manufactured home. But that question does come up a lot. So if you're an agent and you have clients asking about that, you can always ask us for some clarification on it, but they are more difficult, and it's almost impossible to clarify them as a 2-unit, and you actually don't want it to be a 2-unit when there's a manufactured home. You want it to be the inferior piece of the property and have it be an accessory dwelling. With that, when you're talking about multi-units, there are some good properties with accessory dwellings, and now FHA and some conventional products will allow us to utilize the accessory dwelling for some income qualifications. A simple thing about it is we can only use 30% of that rent to offset the overall income, but it still is a really good option if you have a client who finds a house with an accessory dwelling. I personally have one. Dave here at the office has one too. It's a great option. So if you find a house with an accessory dwelling, it can also create that residual income, but then also you can utilize that income to offset that mortgage as well on your application. Okay, so just to recap, we talked about FHA, conventional, VA, a little bit of manufactured and accessory dwellings, the low down option, VA 0 down, FHA 3.5% down, and conventional is 5% down. Those are all, again, for your primary. So they have to live in one of the units for all those programs. The minimum credit score is actually 620, but potentially lower for FHA and VA. So keep that in mind when you have a low credit score borrower. And then also having the ability to do a 5 to 24 unit apartment complex. That is an option as well. With that option, you don't need to live in one of those units. It is on the investor side. So the down payment for that is bigger, it's 30%, but it is a good option for people who already have a primary and want to kind of venture into that investment world. So that is a lot of information, and I do want to open it up to any more questions that you guys have. You can unmute yourself and we can answer as many questions as possible. And I will also, anybody who came on and who signed up, I will send the video link out as well as some materials to go over and have in your toolbox. So any questions?
Maybe just tell them the DSCR can be done 25-30% down on any number of units in any state.
Yeah.
As long as the rent
covers
the mortgage.
Perfect. So one of the options that I have not mentioned is DSCR. So DSCR is a great investor option. So again, getting away from the primary, the investor option is basically, you're literally just utilizing the home as your income stream. So if your rent is $3,500, we want to make sure the mortgage is right around $3,500. Now, there are some segues to that. Let's say last year, the rates were a little bit different, and maybe the mortgage payment was a little higher than what the market rent was. You can still actually do the loan, but the DSCR is an option that in our office, we can actually do them in any state and also with multiple units as well. So if somebody lives here in Montana and wants to buy in Arizona and found a cool multi-unit, they can do it as a DSCR. It's literally a low document loan option for them. So if you have a client who is venturing into that, let us know and we can talk about that option as well. Anybody else have any questions? 4 more minutes. That was a lot of information in 26 minutes. Well, cool.
I can tell them a quick story.
Oh yeah, Dave has a quick story, but was somebody just gonna get on?
Maria, I had a question for you, specifically for the VA multifamily. Are borrowers able to qualify for a multifamily unit with non-family members or spouses? Say, a member that might be younger and have another veteran they want to go on a loan with?
Yeah, so that's a really good question. Typically, when we're talking about a veteran to veteran that are not married, these are called joint loans. And typically we can do them. And sometimes it requires a little bit of down because of the entitlement that the veterans have. There's a calculation that's done to see. So you may not get that zero down. It depends on how much entitlement they have. But also, if you go veteran to non-veteran, you can still do it. However, they both have to occupy on both these scenarios. And then the down payment will be bigger. It'll probably be at probably, I think, 25%. Because the veteran has his half covered, but then the non-veteran will have to bring in a down payment to cover his portion. Does that make sense? So, but there's a calculation that's done, but yes, it is possible.
Okay, thank you.
Yeah. Cool. And then Dave had a quick story. He's
All right.
hiding. I don't know if you can see
I'm
him.
talking into Maria's mic, but, I'll just go sit in the driver's seat.
Okay, you sit there.
My favorite multi-unit was, in Columbia Falls, there's a neighborhood called Diane Road. And you could actually buy a foreclosed 4-unit property for, I think, $125,000 during the crash. So we had a client that spent 100 and got a renovation loan. So their total of exposure and cost to get this 4-unit property was like 225 or 250. And I noticed recently that these were listed at $1 million. These 4-unit properties over in Columbia Falls. So looking into the future, we have no idea what things are going to be worth, but people that are willing to try these things could end up like that homeowner who had basically made $750,000 by doing an FHA full renovation loan, which we did back in like 2012.
Wow, cool. Why don't you close it up?
We got a whole menu of stuff coming up, so tell your friends, and if you know anybody who wants to see this, it's available on playback. So.
All right, thank you guys.